Welcome to The Explainer. Today we're taking a look at a real game changer, transforming organizational chaos into a well-oiled machine by mastering the fundamentals of responsibility accounting. You know, if you've ever felt like your company's big financial goals and the day-to-day reality of your team are just completely disconnected, well, this is exactly what you need. Because when high-level corporate targets feel like they exist in a totally different universe than the actual operations happening on the floor, it breeds frustration and it completely stalls growth. We're going to bridge that gap right now.
So let me ask you, when a company loses money, whose fault is it? It's a universal business problem, isn't it? The endless organizational accountability issue. The constant finger-pointing across departments where everyone insists, hey, it was the other team's mistake. Well, that stops today. We're going to learn exactly how costs and management accounting should actually be used for managerial planning and control, so we can finally end that blame game once and for all.
All right, here's our roadmap for this explainer. We'll cover 1. The accountability approach, 2. Designing the system, 3. 4 types of centers, 4. Measuring managerial success, and 5. Keys to making it work. Let's get right into it. Starting off with Section 1, the accountability approach.
To really grasp this, we have to make a major mindset shift. While traditional accounting focuses on determining the cost of products and services, the things, our approach here completely flips the script. We are focusing on people. There's a great quote from Horngren that says, "Responsibility accounting focuses on people and not on things." And it's so true. Tracking costs isn't just about spreadsheets and widgets. It's really about leadership and psychology. Ultimately, every single item of income and expense is the responsibility of some human being in the organization.
So let's formally define what we're talking about here. Responsibility accounting is basically a system of collecting and reporting accounting data based on managerial level, directly identifying costs with the specific persons responsible for them. Think of it as a method of budgeting and performance reporting that's built directly around the structure of your organization. It exists to answer one very specific question: who is responsible? It literally personalizes the costs.
Moving right along to Section 2, designing the system.
Knowing the concept is great, but architecting it? That's a whole different ballgame. The design process follows a really logical progression, taking us from carving out areas of influence all the way to gathering actual data for feedback. The 4 steps are establishing responsibility centers, defining the limits to controllable costs, implementing flexible budgeting, and finally, generating accurate performance reporting. Let's break these down a bit.
Okay, this point right here is absolutely crucial. Understanding the difference between controllable and non-controllable costs. Controllable costs are things that can actually be changed by a manager's actions, like raw materials or direct labor. Non-controllable costs, on the other hand, like building depreciation, cannot be influenced by that manager in a given time frame. Think of it like a thermostat. You should absolutely pay for the heat you control in your specific rented room, but there is no way you should be penalized for the whole building's property tax, right? It's all about fairness. If you hold a manager accountable for costs they literally can't control, it instantly breeds resentment.
And to maintain that fairness, we use something called flexible budgeting. Honestly, relying on a static budget is just a really weak way to analyze performance. Think about it. If a manager's department produces twice as many units as originally planned, their total material costs are obviously going to go up. That is exactly why we must adjust our budgets, recasting those comparisons to match the actual production volumes a manager achieved. It gives us a true apples-to-apples comparison.
Okay, Section 3, 4 types of centers.
Now that we have the rules of the system mapped out, let's explore the anatomy of the business. You can think of these as escalating levels of autonomy. You're moving from simply managing expenses all the way up to controlling massive assets. At the very bottom, cost centers only worry about expenses. A step up, revenue centers add the responsibility of generating sales. Profit centers look at both to generate a profit. And at the very top of the ladder, we have investment centers. Let's clarify the subtle but really vital distinction between those top 2 tiers. A profit center is evaluated purely on the excess of revenue over expenses. So imagine the manager of a furniture department inside a massive store. They just need to sell furniture for more than it costs to buy it. But an investment center, they're evaluated on the rate of return earned on the actual assets invested. That's like comparing that furniture manager to the manager of the entire branch chain, who is responsible for the building, the inventory, and literally all the capital tied up in that location.
Which brings us to Section 4, measuring managerial success.
With our centers established, we hit the most mathematical but honestly kind of dramatic part of our explainer.
How do we know if these managers are actually succeeding? Well, let me walk you through a classic goal congruence dilemma. Say a division has a current profit of $100,000 on a $400,000 investment. Their return on investment, or ROI, is a fantastic 25%. Now, top management says, hey, we have a new investment of $200,000 that'll generate $40,000 in profit. That's a 20% return. Highly profitable for the company, right? But wait, look at the blended result. If the manager accepts it, their personal division ROI drops from 25% down to 23.3%. A manager evaluated strictly on ROI might selfishly reject this awesome project just because it lowers their personal average.
So how in the world do we fix this? Enter our hero, residual income, or RI. Residual income is simply the profit remaining after you deduct the cost of capital on the investment. Let's pause to really let that sink in. Instead of chasing a percentage average that can get dragged down, we're just subtracting a flat capital charge directly from the profits. Because we're looking at an absolute dollar amount instead of a ratio, RI ensures managers are motivated to accept all projects that benefit the company overall. If a project makes even one single dollar of residual income above that cost of capital, the manager's total performance metric goes up. It's brilliant because it perfectly aligns their personal incentives with the company's growth goals.
Now, what happens when these massive profit or investment centers trade with each other? Well, that's where transfer pricing comes in. When large divisions in the same organization trade goods internally, they use transfer pricing to maintain their profit independence and keep performance measurement fair. They might use market-based transfer pricing, which matches external competitive prices, or cost-based transfer pricing, which uses internal manufacturing costs. Picking the right one ensures no division is unfairly subsidizing another, keeping the whole accountability system perfectly balanced.
And finally, Section 5, Keys to Making It Work. Let's look at the essential success factors to make sure this entire system acts as a morale booster, not a demotivator. A system is literally only as good as its implementation. You need clear organizational lines, management by objectives, and timely reporting because, let's be real, performance reports received 3 weeks late are completely useless. But I really want to highlight participative budgeting. This is how you get managers to actually buy into their goals. Why? Because they helped set them. When a budget is a negotiation rather than some top-down mandate, managers will put their heart and soul into attaining it.
Another massive key to success is management by exception. This essentially means don't micromanage. Executives should concentrate their attention only on exceptional or unusual items of deviation. This system works best when leadership only steps in when the performance reports show major unexpected variances from the plan. If everything is running smoothly within the flexible budget, leadership stays out of the way. It empowers your team, fosters immense trust, and saves leadership a ton of time.
I want to end our explainer today with this final thought to chew on. Are you actually measuring your team on what they can control? Take a second to reflect on your own organizational alignment. If you hold people accountable for the uncontrollable, you'll absolutely destroy morale. But if you design a true responsibility accounting system, you empower your leaders, you perfectly align your goals, and you unlock some incredible efficiency. Thanks so much for diving into this explainer with me today.